Welcome to Web3 Watchdogs, the podcast that takes a deep dive into the world of Web3 security, compliance, and risk. Join Michael Pearl as he interviews executives from across the Web3 industry to uncover the challenges and opportunities of this rapidly evolving space. Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.
Hello, everyone, and welcome to the Web3 Watchdogs, the podcast that discusses everything security, risk, compliance. And today we have with us Ryan Mueller. Ryan is the CEO of Phantom Compliance. Ryan, I promise that I will let you introduce yourself because you'll do it much better than I do. So please, Ryan, the floor is yours.
Awesome. I'm Ryan Mueller, CEO and founder of Phantom Compliance. Started working in magical internet money 22 years ago now in the e-wallet industry when it was still early. So long ago that PayPal still did payments for online casinos. And since then, we've had a pretty long run doing risk management, merchant account underwriting, merchant account issuance, financial and commercial risk controls for settlements, led that into underwriting of businesses for payment acceptance, which brought us to the world of crypto. Phantom was founded 16 years ago and is a relatively large team with a head office in Calgary and multiple other offices throughout Alberta, opening an office in British Columbia shortly. And yeah, we're just out here doing outsourced compliance, modular compliance, advisory. I'm not your traditional vendor in that we also have the consulting and operational help aspect. So, we file reports for clients, we do onboarding, these kind of things.
So your journey is risk management, compliance, and as you said, you did payment processing and gaming and crypto. So I wanted to ask you, those are all kind of high risk, high volatility, high frequency industries, right? But what are the differences between them in terms of risk, in terms of compliance, what you are expected to do from the regulator side, and also the companies? What can you expect to see from your clients in terms of their attitude towards compliance?
I think with regard to differences, industries like the foreign exchange and online gaming are a lot more, let's say, mature than the crypto industry, especially when it comes to integrating and interacting with traditional finance, interacting with bank accounts, payment processing, credit card payment processing. So we found when we started doing payment processing for crypto like over 10 years ago now, the concept of there being differences between push transactions and pull transactions. So push, user is participating, they're sending you the funds. Pull, user gives you information and you just go get the money later. So, back then we were having to explain the difference in commercial risk profile between a push and a pull and what clawback risk was and so on. And coming from doing payments for online gambling, doing payments for FX, it was like, well, how does anybody not know this? But, I think most of the crypto industry has kind of caught up to that now. But key differences is like what people care about. So when we work with crypto companies, they're primarily concerned with accessing USD banking and having access to the SWIFT network, where when we talk to online gambling companies, they're like, I really need to accept Visa, MasterCard, and I really need the acceptance rate on the merchant category code to be above a certain percentage or whatever so that I can, make more money. Or I really need you to accept the Anjouan or Curacao license I might be operating under, where most banks won't do that. So I guess the similarity, just kind of summing it up, is that all of those industries are used to doing a lot of stuff in order to be able to accept payment, hold funds, and then, pay those funds out either onward in their corporate structure or to their end user if somebody hits a jackpot or whatever. So I think the similarities are all that those industries were all gray, and, depending on who's in government and whose voice is the loudest, become gray again in a cyclical fashion.
Yeah, I hear you. And I think you made a very good point with respect to the relationship with the banks, and not only the banks, also the payments companies, because just, to simplify it for the listeners, at the end of the day, crypto companies need to accept fiat and then to on-ramp and basically to sell crypto. They are essentially vendors of crypto. Then later on, they can do kind of upselling with respect to, internal swaps. But the on-ramp and off-ramp element is crucial because, again, needless to say why. And this is a very, very important point where most companies have real trouble. And there was an article on Forbes recently
Right.
on how difficult it is for crypto companies to have a normal relationship with banks. And the slightest mistake, let's say your client gets defrauded, or for instance you have some sort of a gap with your compliance policy, and you can lose your bank, basically your bank account, or your client that wants to deposit cannot deposit because you are on some gray list. So if you can zoom in on that, maybe some use cases, because it's really interesting and I hear this concern and it's growing.
Yeah, I mean, we've been through it many times, doing this. And back when it was like, okay, online gambling companies needed to accept credit cards, not as a 7995 transaction because the MCC code, their bank would block it because they hate it. So that's why the entire e-wallet and voucher industry sprung up to support online gambling. And similarly in crypto, 10, 11 years ago, when no one was regulated, when no one thought crypto would last, banks were still hesitant because of the legacy of e-gold, because of the legacy of the Liberty Reserve. They thought, okay, this is an avenue for fraud. This is an avenue for people to buy heroin and guns. Selbrecht is in the news again, speaking of heroin and guns. But, it was sort of like, okay, everybody had a services business or a marketing company that they were using to accept these wires and send these wires like 10, 11 years ago. And it's sad to say, the more things change, the more they stay the same. Because after FTX, I mean, every crypto-friendly bank, especially that facilitated in and outs of USD, was demarketing, every crypto company, or they were getting rid of all payment processors that service crypto companies. And I don't think we'll have enough time to discuss the way that the structure of the correspondent banking network for US dollars is set up and why, these nested flows that end up where you're a crypto company, you might be a seventh party transaction to the correspondent bank that processes your transaction, which is a nightmare for, all 7 chief compliance officers in that chain. I think that we find, and I'm really wandering around on your question, and I hope you'll allow me a little license in answering it, but we find people don't even really understand how money moves often. They think, well, when I send Bitcoin, I click a button and it goes and I get a notification and that's it. Where, a bank wire might take 12 days. Because it might go through so many banks and they're going, well, where's my money? Who took it? Why does it take this long? What's going on? So, we're starting from a foundation where not all the stakeholders truly even understand the product that they need, the service that they need, and how it works. And then you get to the point where, there's this, I guess, closing pressure from the top where these bank compliance officers, God bless them, God bless every bank compliance officer listening out there, they don't really understand crypto. And they haven't come from a place where they have the time to understand it. And they also aren't coming from a place where banking people in the crypto industry is profitable for them. So, in April of last year, I lost a bank account for Phantom that I had had for 15 years. I lost my yen account, my euro account, 2 USD accounts, CAD account, Canadian savings, line of credit, travel credit card and everything. And they kicked me out solely because I get paid in crypto a lot. And I off-ramp that crypto to Canadian dollars, and then I pay my staff and I pay my rent and whatever. And the place that I buy and sell crypto was in the news because somebody defrauded another bank and monetized that fraud by, selling Bitcoin through this provider. So they thought anybody that's ever touched these people is high risk. This guy's gone, because if I'm sending 10 wires a month and paying my monthly account fee, is my $500 in fees worth it for them? It doesn't matter what interest they might earn on my minimum balance. None of these things matter. They're like, this guy's worth $500 and goodbye.
It's high risk and small money. But I'm interested, just to open a bracket here. With respect, you were talking about an exchange that you were dealing with that essentially had some sort of a fraud issue related to it. If you want to name names, you can, but If not, I just want to understand this use case. So an exchange, essentially, for the listeners that don't know that, an exchange has several hot wallets, not too many, right? So in this particular use case, if I understand correctly, a certain hot wallet was basically plagued or flagged rather due to some fraud. And then everyone that was interacting with that hot wallet essentially was in a problem, right? With respect to compliance and off ramping.
It's close. So somebody hacked one of the regional banks in Western Canada, stole 20 million from their payroll account, wired those funds into another bank that they had used a deep fake identity to set up that account, and then bought a ton of Bitcoin with that money. And the original bank that was hacked sued the provider, and we can talk about it because they won. It was Aquanow. You know, we love the Aquanow folks. We love what they do in Canada and around the world, and we're thrilled that they won because somebody taking money that another bank accepted and buying Bitcoin with it. I mean, come on, they can't be, you know, held accountable, held to know anything. They're just like somebody's showing up with free and clear funds, and I can sell them something. And we had a similar case that we won in Saskatchewan. And by the way, I'm not a lawyer, but I get involved in this kind of stuff all the time. You know, several years ago. And one of the points that we made throughout that trial was like, listen, if this guy stole this money and came and bought a boat from me, you would never bring a guy that sells boats into that room and sue him and this and that. But because we're crypto guys, it's appropriate to try to take that money from us. You're never going to take the boat dealer in there. You know, so anyway, it's just interesting. And I think this touches on some other things that we're going to maybe talk about in this session. But yeah, just wandering back to it. I mean, you know, these kind of issues, your bank can just run for the hills after, you know, a decade of service based on they don't understand crypto, they think it's scary, and they don't want to be fined. And that's it.
Yeah, just a side note, I think the point that you're raising here, and actually the story that you told right now with respect to, you know, a bank being hacked, and eventually dirty fiat money went into the system and bought crypto, right? And that's not something that we're used to hearing, because the crypto industry is so much self-focused that we keep talking about crypto only, but we don't understand, or most of us don't understand, the fact that you cannot have this detachment between the fiat and the crypto world. It needs to be there, it needs to be streamlined, and you need to talk about that as well, because in those places you have the biggest compliance challenges, right? And now, I mean, to some extent, this is being solved by a massive use of stablecoins, right? Because when you are holding stablecoin, essentially you're not in a volatile asset, but you are already on ramped and you can basically play with it as you wish. But we're not there yet. And even the stablecoins have a fiat element. We're not going to go into that. So just a side note, I think that a little curiosity about, you know, the on ramp and off ramp, which are pivotal points in crypto, is very healthy for the industry.
I mean, if you can't get money in and out, you're irrelevant, right? Like if you can't buy a pack of gum, you can have all the Bitcoin in the world. It doesn't matter.
Exactly. So I wanted to talk to you. I saw a video of yours. First of all, kudos for the guerrilla marketing. Looks really nice on your LinkedIn page. So you said something along the lines of crypto compliance has to be perfect. Otherwise, you can face jail time. So it's quite a provocative statement. Can you elaborate on that?
Sure. I think the spirit of this statement is just we have a broad range of experience, and I mean we have clients that are, you know, they're fiat currency only clients. They're shop fronts for family remittance where people take $100, go put it there, send it to their abuela. The end of the line. You know, there's no crypto in that flow. There's no nothing. And that's very vanilla as far as I'm concerned. And, you know, we get into these shops and they're like, yeah, we do sanction screening once a month, maybe. We store the KYC on like an old Windows machine in the back of the shop. If this client is listening, they know who they are. I'm not going to name them, but you know, and then you go to crypto and it's like, you guys have to be SOC 2 type 2. You have to have full penetration testing and automate. You have to have a safeguarding account over here. If you don't prove you sanction screen every time the wind blows, we're going to kick you out, you know? And it's just, there's this hyper focus, and I think it's healthy for industry because it keeps bad actors out. It's like a roller coaster. Like if you must be this tall to ride, that's it. Like if you can't afford it, you can't play. You can't hold people's money. But I think it's really funny, and I know a bunch of people that do what we do. They do fractional chief compliance officer in exclusively in investment products, exclusively an exempt market dealer and alternate transaction systems and stuff. And the worst boiler room junk bond stuff still occurs there, where people are phone banging in call centers and selling trash securities for government money. And you can do whatever you want there. Those guys have 5 bank accounts. It's fine. But then, the biggest crypto companies still struggle to get access to modern banking in Canada and the world. And it just, it's fine. I'm not here to say, oh, poor me, or, I'm not Sisyphus complaining about pushing my rock up the hill. But it's just kind of funny, I guess, and I think it kind of determines how successful you can be if you can overcome these kind of challenges, and figure out how to make these banking products that you end up with access to work.
Yeah, but I also think that some players in the industry are not behaving well for us to make those claims, right? And at the end of the day, it's quite a small industry. And, when you have, highly publicized cases like hacks, like fraud cases, not the one that you've mentioned, because obviously the crypto exchange had no really hadn't had anything to do with it, but real fraud on crypto platforms, eventually this can really cripple the reputation of the entire industry, which is so fragile, right? And every once in a while, every like quarter, you have this giant hack or giant fraud case, and then it just ruins it for everyone.
I was, if you want to go back in time, like I was interviewed in Vanity Fair about the Quadriga fraud, and Quadriga applied to the payment processor that I worked for. It might be 10 years ago, crazily enough, as time flies, and we declined them. And we had this whole file on how, Michael Petrin was Omar Donani and all this stuff, and nobody cared. And then, everybody cared when those guys, when all that happened. And yeah, I completely agree with you. It is cyclical, but I think it's cyclical in TradFi too. I just think the news cycle holds on to the crypto bad stuff a little bit longer. Because I guess we're still, scary. We're still what scares people. It's,
Yeah, I totally understand. So let's dive in deeper into crypto platforms. So let's say I'm a crypto platform. Let's say I opened a new crypto exchange in Canada, of all places, right? And so I think I understand fairly well what I need to do to communicate with banks. I think we covered that. But let's talk about the crypto element. So I'm required to do a KYC. That's already kind of a given, right, for everyone. Mm-hmm. But with respect to funds that I'm receiving and to funds that are outgoing from my system, what are the expectations? Because this is something which I see as kind of a gray area, because there is no like gold standard for how well do you need to vet the funds that are entering. How many hops do you need to go backwards to figure out the money trail? It is something that, it's not that it varies between jurisdiction. It's not written anywhere, and everyone has their own kind of practices. So can you kind of clarify on what you understand are the requirements from the regulator point of view, and obviously in different jurisdictions?
Totally. I actually absolutely love this question because there isn't guidance even in registration or licensing for virtual asset service providers or crypto exchanges or exempt broker dealers or whatever word salad you're throwing on the front of people selling crypto assets, right? There isn't guidance in that legislation that says if it's 3 hops to Garantex or it's over 1.2% of the total wallet activity in this period of time equals bad. Right? There's no simple equation that if this, then this for crypto forensics. And there has been, because it's a tumultuous time globally, there's been updated sanctions guidance on and on, ongoing. These parties are sanctioned. These parties are sanctioned. This is this. And I guess, this question came to the crypto industry. It was already there. But it was easy to say, okay, well, I don't want direct transactions from Novitex because Iran is currently sanctioned by Canada Ergo, I'm going to block anything that I can attribute to a Novitex exchange wallet. And it's easy, right? And if somebody attempts it, I can file an attempted suspicious transaction report. I know exactly what to do. But now, especially with stable coins and especially with crypto just behaving like money, sometimes money touches bad stuff, or sometimes money touches things that, somebody says is bad, and it triggers a reporting obligation. And we got this. I mean, I think it all kind of really started, frothing up. I mean, the OFAC has been sanctioning wallets since, whenever. But this all kind of started with the Russian invasion of Ukraine, that, and Garantex and other of these exchanges becoming sanctioned entities. All of a sudden, all of these stablecoin wallets have become dirty. And there's thousands, tens of thousands alerts for everybody to work and everything. And I remember we were a Chainalysis user then. I remember one day, like, my team logged on and we had 20,000 new alerts because a wallet had been sanctioned that it wasn't even active anymore. But it had been added to sanctions, and then all these garbage transactions under $100 are flagging up alerts. And I'm answering your question in a really long way, but to put it very succinctly, there's like a lack of maturity in the compliance folks that are working this, because they're like, who even knows what to do? Maybe they've been doing crypto forensics for like a year, right? And they might not have a really good understanding of money. And then there's no government guidance. So it results in, I'm going to report everything, but maybe I don't have the resources to report everything. So maybe I'm going to demarket that client. And then you have LPs upstream from the exchange or whatever being like, we got this alert. We don't have any resources and it's your problem. Figure it out, or we're going to demarket you. So it's this huge, stressful, urgent situation. And I mean, it's like, I hate that the answer is this simple, but it's like, does this make sense as a terrorist financing or money laundering flow or not? Does it make sense that this money touched a bad wallet 4+ years ago and $1.25 remain in that flow? I don't know if that's a concentrated effort to finance a terrorism event. Maybe it is. Like, does this money move rapidly, the amount stay consistent over a short period of time and end up somewhere? And I mean, that's an overly simplistic example because people are getting really creative with how they're doing this stuff. But yeah, there's no guidance and it's a tough scenario. It's hard to be successful.
Yeah, and what's interesting is the fact that, OFAC sanctions are actually, in my humble opinion, are the easiest thing to do, because at the end of the day, out of all dirty money that you can think of, OFAC sanctions is quite straightforward, right? Because they're flagging wallets. But it becomes much, much more complex when you're talking about AML, right? Anti-money laundering. And when you talk about, other types of dirty money, which are maybe not that of a, red flag, but they are kind of a pink flag, you know what I mean? Like money that orients from hacks, scams, fraud. And then it becomes even more complicated because it's harder to trace it, and you don't have any guidance for that altogether. For the OFAC sanctions, given the fact that it's kind of an international issue, but with respect to scams and fraud, which could also get you in trouble, it's really hard to figure out what's what, right?
In the news right now, there's, stats that like pig butchering is taking, $20 billion out of countries and things like this. And we've worked as like the outsourced provider for retail platforms. And it's a massacre with these people that they're engaging with very sophisticated fake platforms that send them statements, show performance. They have an account manager, or, they fall for a romance scam. And there's no, as a service provider, you can insulate yourself from the commercial risk, but you can never prevent the fraud victim from being groomed and lying to you. We had the lady sell her house, buy Bitcoin, give it to somebody that was romance scamming her. She wouldn't, tell me anything. When I asked her, I was like, we're concerned about you. This isn't normal. She was very rude to me, told me many things about where I should go and what I should do when I got there, and it was like, okay, well, okay, whatever. And then the next week she's like, I'm homeless. Sorry.
Yeah, I totally agree with that, because there are two elements to it, right? So pre, sending funds, if you try to prevent it on the real life level, on the Web 2 level, let's say that you're not really good at privacy and you do some crawling in the chats that your clients are doing, just in theory, right? and you catch, some client of yours chatting with someone who is clearly a fraud, if you've warned them, they're not going to believe you, right? In most cases. And if you do
They're
it
gonna get
post,
angry.
yeah, they're going to get angry just the way that you described it right now. And if you do it post, right, if you do it later on when they already sent like 1, 2, 3 transactions, but because we all know it's a multi-transaction scam, they are too embarrassed to admit it, right? So they're already kind of in the loop. So it's a big problem. That's why, in my humble opinion, the way to counter this is from the Web3 point of view, right? And that's something that we're doing with our clients when we show them how many wallets that their clients are interacting with. And again, hot wallets. So the exchange essentially interacts with so many wallets that are unflagged, right? They will be
Right.
clean in any incumbent system. Whereas when they check it with our system, they see that, it's a pig butchering affiliated wallet, Roman scam, investment scam, phishing, and so on. So that's, in my opinion, the solution for that is from the Web3 side of things. And then, it's up to the exchange to decide on the policy, whether they want to block, this wallet altogether, issue a warning to the user, whatever they want to do, and depends on how liberal they are with what their users are doing. But I think, they need to wake up to the fact that there is a solution and they need to do more about it. And now, regulators are actually pushing them to do that.
Yeah, I agree. I think, protecting retail investors and limiting retail fraud is not only just an objectively good thing, but it's also usually kind of the leverage that folks are using to say you don't get to have a bank account anymore. You have to now be regulated to a much higher level because, some financially illiterate or, hopeful people lost money. And, I guess we're real focused on these fake exchanges rather than like shit coins and rug pulls right now. But, I think the potential for loss is the same. I think the news cycle has already moved on from Hawk Tuah coin, but we're not regulating Haley Welch. We're just going after exchanges that already have.
And also, it's interesting the fact now that you have so many regulators that are actually starting to notice this and starting to act, right? So you have the FCA, they have the APP fraud, right? Where essentially they're demanding a reimbursement for their clients that were defrauded. In Singapore, the MAS are doing kind of the same thing. And now with the CFPB in the US, where they're examining, by the way, it's relevant for gaming as well. You probably heard about it. They're thinking of demanding a reimbursement for clients that were defrauded, essentially mostly for, romance and investment scams.
Sure.
So yeah, the regulators are definitely catching up with that. It's going to be interesting to see how it works. In the UK, some exchanges and some PSPs are already losing funds for that. It's going to be interesting to see the other jurisdictions how it works.
I think that for a little while longer, in jurisdictions like Canada and Europe, we're going to see regulators tipping in favor of retail investors and against exchanges. And you're going to see those kind of demands and so on. And when we worked, retail onboarding, retail validation, we would have banks all the time like, hey, we got a wire recall. We would love to have that money back. And, we'd say, well, this is everything we did. We're not really prepared to give you the money back. And they'd be like, all right, see you later. But that doesn't necessarily work all the time. And that doesn't necessarily happen with, less. Because we learned how to do it all from gambling fraud. So it was like, we know how to prevent wire fraud, like no problem. Whereas, some of these guys that are, maybe they don't have the TradFi history or whatever, they don't know how to manage that. So anyway, what I'm about to say is that we were in scenarios where we didn't lose the money ever. And the bank would just say, okay, fraud victim, you lose the money. You go file a police report and you'll get, a law enforcement officer that has an insane caseload because that's how that works. And then he or she doesn't understand crypto. And then you lose your money forever. And we've worked some really good cases. I'll mention the Durham Regional Police Service on this because I've worked with a really dynamic and dynamite investigator out there. She's been phenomenal. We've had like 4 successful prosecutions, recovered funds for victims. But if you don't draw, an officer from the pool of people getting assigned to you that cares and knows how to do it, you're never going to get your money back. We had one guy, he had like hired somebody to, fix his home computer, and they stole like 1.2 BTC from him. This was like 3 years ago. And we got him his money back like on December 23rd. It was like, Bitcoin Christmas miracle, and we all felt really good about it. But, and it was so long ago that right after that, Bitcoin mooned to, at that time, like maybe sub K. Anyway, he had a good Christmas. So, yeah.
Yeah, it definitely getting your money back is complicated, and especially in
It's
crypto,
hard out there.
for
Yeah,
sure,
it's tough, man.
for sure. So I wanted to ask you, another element of compliance is reporting, right? So in the TradFi space, everything is quite, again, much clearer, and the roads are paved already because so many people have done this before you. And essentially, the regulator says, "Listen, I need you to report everything, or not really everything, but the more sensitive stuff to me automatically, and I'm gonna figure this out within my data sets," right? How does it work with crypto? Just to give you an example, right? I'm receiving funds, and if I receive something that might be, gray area or dodgy funds, or as you've mentioned, like 1% of the funds are flagged and the rest are okay, are there any reporting requirements in the crypto space with respect to the regulators?
Yeah, 100%. So, I mean, in Canada, there's a variety of obligations. Like if you receive over 10,000 Canadian dollars equivalent in a 24-hour period and one or multiple transactions, you have to immediately report, well, not immediately within 5 days, but who the sender was, if you know the purpose of transaction, if you have forensics, blah, blah, blah. And there also are TradFi reports like, did you send a wire cross border on behalf of a user? And then, of course, there's, the suspicious transaction report, the terrorist property report. So in terms of reporting, the regulatory approach of being like, crypto's new, it kind of looks like something we already understand. We're going to slap the old reporting framework on it. That's 100% alive and well in every jurisdiction. And those, I guess, reporting requirements and guidelines are the same as they are in TradFi. So it's above a threshold amount. Report it. It crosses an international border and may have tax implications. Report it. It involves paper cash. Report it. Or you're suspicious about it, right? And I think the very broad guideline of suspicion, and I'm going to stray into opinion for it'll be done in under 2 minutes. A very broad guideline of, if it's suspicious, if a reasonable person would be suspicious, then you have the obligation to report. So now you have a person who maybe they care about their job, maybe they don't, right? Like not everybody that does jobs cares about them. So they're like, well, anything could be suspicious. I don't want to get in trouble. Yeah, I got stuff to do tonight. So suddenly they're like, I'm not going to investigate. I'm going to flag and report this transaction. And then maybe, the bank or the exchange has a 3 SDR and you're out kind of policy. So that can result in the demarketing of a real customer. But what it really ends up is everybody's over reporting. Because in Canada, all the banks just got fined for underreporting. And it's like, okay, well, I better, if I'm suspicious at all, I'm going to file a report, and I'm going to get back to the part about automating this. You can automate threshold reporting. Amount is here. These are the details. Bang, and it's gone. But you can't automate suspicious transaction reporting. I don't think that large language models have advanced to the point that they can write a coherent narrative for a suspicious transaction. And I don't think that we can automate the investigation. So you end up with this crushing weight on small, under budgeted compliance teams where if they don't report everything, they're in trouble and they get fined, but they can't report everything because they don't have any resources. Anyway, I'm just keying off you mentioning the automated stuff because I don't think industry has figured that out. I don't think industry even has the travel rule figured out. And it's just interesting. It's tough. It's tough because it's a high bar.
Yeah, so on that note, first of all, the travel rule, I think it's a little bit easier because it's kind of been thought through and there's not that many technological challenges there, right? But with respect to what you're saying with automatic flagging and automatic reporting, that's actually something that we figured out. I'll be happy to show you this offline, but there are solutions that are already doing that. And definitely you guessed it correctly that, AI models and LLMs are involved in it and there are already ways of doing that. I
Amazing.
think I think it's a good segue to ask you the final question,
Yeah.
which is quite closely related to that. So, with respect to forensics and tracing, you have kind of, let's say, between 3 and 5 and 6 companies, not going to name names, but we all know who we're talking about. Do you think that the tools that are out there are sufficient in terms of the quality, in terms of the speed of things, in terms of the technology that is the underlying technology to actually meet the requirements, the compliance requirements of the regulator? So, again, flagging, tracing, being accurate, no false positives, and so on. From your experience, are they good enough?
I think my answer has to be best. It's best in show. Listen, it's definitely not the best we can do. It's definitely not the solution that I would want. So let's go back in time to 10 years ago. I'm processing all Canadian dollar payments for a group of exchanges, and I ask all of them to just allow me to confirm if funds are going to a name matching or not matching after the customer on ramps. And they're like, we don't want a third-party Java library on our checkout. We don't want to give information to other exchanges. We don't want this. We don't want that. So, I think we all agree that, these things are necessary, but I don't think that like technology and I don't think that dev resources are there. But I'm also used to investigating frauds and money laundering and so on. Might involve physical vouchers at some time, might involve paper cash at some time, and then go into bank accounts. And frankly, I'm thrilled every time I investigate a crypto case. That's not a lie. I'm actually thrilled because I can track how the money moves very readily with a lot of visibility in crypto, where if I'm doing it in a bank, in a case that only involves traditional finance, I see one hop. I see it landed in this bank account and that's it. And I might not even see the proper, bank account holder information. I just see what someone entered. So, to get to the crux of your question, is it sufficient or not? I mean, it's not the best it could be. And you're never going to really know what somebody spent money on 5 years ago. You're never really going to, you can see the data. You can see that these funds move, but you're never going to know the full narrative. But is it better? Yes. But there's also, I think, a lot of challenges in industry right now. Incumbent long-term providers shutting off their service provider program. And via that service provider program, demarketing hundreds, if not thousands of parties from accessing good data about illicit activity on the blockchain. Maybe you know what I'm referring to in a very oblique way there. Maybe you don't. One of the big kind of crypto forensics ones just demarketed all their smaller vendors, which is like, I've never seen anything like it. I've never seen anyone be like, we do not want $70,000 from you this year. See you later. But I think, I don't think it's giving exactly what we need to understand true narratives and true purposes for transactions. But I also think that expectation is unrealistic. So I think it's amazing. I think, tracing, forensics, reporting, everything is improving. But I don't think it's like an end state right now. And I'm never a person that is like, this is great. And if it's a sandwich, maybe. But a technology solution is always going to be better.
Yeah, in my humble opinion, the pace of the technology that is evolving in the crypto space, we mentioned stablecoins and, the whole DeFi space and the lending and the atomic transactions and the cross bridging and all that. At the end of the day, the forensics and the tracing solutions, most of them are not keeping up with that. So I think that the discrepancy between what regulators expect and what they are getting in terms of tracing and so on will only grow.
They frequently have unrealistic expectations, though. I mean, we were in a consultation about stablecoin regulation in Canada, and one of the regulatory guys, who's a great guy, he has good ideas, I know him, he's like, I want data. I want data of how Canadians are using stablecoins. And it's like, brother, we all want that data. It's not there. We can have the first step be that we go to knock on doors. Oh, excuse me, how are you using stablecoins? It's just, the technology is already so far out of the box, already so far gone that if you're starting with gathering data that doesn't even exist and that the users are probably very hostile to you having, Because early stablecoin adopters aren't like, I can't wait to tell the government what I'm doing with stablecoin. Even if it's the most benign use case ever, early adopters are private people that are drawn to stablecoins for some of those reasons. So anyway, it's just laughable that, we're still trying to put these old hats on this new thing and just let's get some data. We would all absolutely love to have data, but we also have to operate. We all have to wake up and process transactions and put on our pants one leg at a time. So yeah, I agree that the solutions are being outpaced by industry completely. Users are fast.
Ryan, on that note, it was fascinating.
Nice.
To be honest, we strayed off from the questions, but it was really interesting because you have so much experience and this whole connection between fiat and crypto. I think it's super interesting. And I think it will be very valuable for our listeners, but that's all the time that we have. So maybe we'll do kind of a follow-up later on. So thank you so much. And
Thank you.
just before we go, remember to like, share, rate us 5 stars, recommend to your friends. We're live on all the podcast platforms, on YouTube as well. Ryan, thank you so much. Bye-bye.
Thank you very much.
Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.